Karen Lin. This video clip is to demonstrate the consolidation process in Chapter 2. First, let's talk about consolidation when the subsidiary dissolves. This is the information we have from the textbook. So if you look at the textbook, it's the case in the textbook on page 49. BigNet acquires Smallport. BigNet company acquires Smallport company. Here is the financial status of the two firms at the acquisition. The Smallport company is the subsidiary, which is the target to be acquired. So it has the book value and it has the fair value of its net assets. So if you look at the book value, the fair value, they are actually differ pretty widely. Talk about when the subsidiary dissolves. When the subsidiary dissolves, all assets and liabilities are consolidated to the parent's book. So I want you to pay attention that when the subsidiary dissolves, the parent actually take over all the assets and liabilities and record them in the parent's accounting system. So there are three scenarios here. The first scenario is that the BigNet pays exactly the same amount as the fair value of the net assets of the subsidiary, if you look at here. So what the BigNet did is that the BigNet record all the assets, current assets, computer and so on, and all the liabilities on its own accounting system. Also, it pays cash, and it issued common stock, which is the par value, and all the extra value that above the par of the market value are recorded at additional paid-in capital. So you should be able to understand this if you understand the intermediate accounting. So if the parent acquires the subsidiary at exactly the same amount of the fair value of the net assets, it just record all the assets and liabilities to its accounting record, and it's done. The second scenario is that the parent company actually pay more than the subsidiary's net assets are worth, which is at the fair value. So when the BigNet pays more than it should, for example, in this case, it paid more cash. In the first scenario, it pays $550,000, but now it pays $1 million. So the difference between the two is that the BigNet pays more, which is $450,000. That will be recorded at the goodwill. So basically, it says that other than all the assets and liabilities that the parent company acquires, the parent company actually pay extra, which will be assigned to the goodwill. The third scenario is that when the parent company pays less than the subsidiary's net assets are worth, there's a typo here, are worth. And if this is the case, the subsidiary will record the bargain gain. In this case, for example, the subsidiary didn't pay any cash, so we need to compare this with the first case where the subsidiary actually paid the combination of cash and issue common stocks. In the third scenario, the parent didn't pay any cash, so the underpayment here, if compared to exactly the same case, that the parent actually has a gain. This gain is also recorded at the parent's accounting system as the gain on bargain purchase.